Welcome back to the deep dive. Okay, you've handed us quite the stack today. Corporate filings, Q2 earnings, technical charts, lots to sift through. Our job is to cut through all that and give you the quick insight. Today we're diving into MosChip Technologies, their big name in India's, growing semiconductor scene. So the mission is clear. Take these financials, strategy docs, stock analysis, and figure out what's really driving this company. We're looking at Q2, fiscal 26, their recent moves, and how the market's reacting.
Yeah, and what jumps out right away from all this material is this, let's call it a dual acceleration. It's pretty clear you've got strong fundamentals. On one side, the business itself is performing really well, profits are way up. And then on the other side, you see it in the stock price real momentum, a significant jump lately. And it all ties back to, India really pushing to build its own semiconductor ecosystem. They're right in the middle of that tailwind.
Yeah. Okay, dual acceleration. I like that. Let's unpack the first part, then the fundamentals, the numbers. We have these unaudited, consolidated results for the quarter ending September 30, 2025. What's the headline here?
The headline, consistent, pretty aggressive growth, especially on the profit side. Q2 consolidated revenue was 146.94 crore. That's solid, about 8% growth compared to the previous quarter. But the really interesting part is the net profit. It came in at 12.15 crore. Now, that's up 12% quarter on quarter, which is good, but it's up a very impressive 25% compared to Q2 last year.
25% year-on-year profit growth. Yeah, that gets your attention. But the sources also gave us the half-year view, H1 FY26. Does looking at the bigger picture change things?
Oh, absolutely. It shifts the story from, solid growth to something more like explosive growth. Looking at the first half of this fiscal year versus the same period last year, H1 FY25, revenue grew 37%. That's strong. But get this, the net profit, it surged. A massive 68% increase.
Wow, 68%.
Yeah. It really suggests they're not just growing the top line, they're managing costs or improving margins while doing it. It looks like their strategic moves are paying off, and fast.
68% profit growth. Okay, that definitely makes you sit up. And it suggests maybe some serious financial discipline. Speaking of which, something else popped out in the filings, the term debt-free. You don't see that often in this sector.
Right, and that's a really important point about their stability. The sources explicitly state MosChip is debt-free for the first time in 5 years. Now, for a company in semiconductors, which is, capital-intensive, often cyclical, being debt-free, that strengthens the foundation massively. It's like a buffer.
Okay, but hang on. If growth is this strong and the industry outlook is so positive, wouldn't a smart growth company maybe take on some strategic, cheap debt right now to fuel even faster expansion? Is being debt-free actually a bit too conservative?
That's a fair question. It's always a balancing act, right, for management. But I think in this context, given they are funding major R&D and acquisitions organically, we'll get to that, but being debt-free gives them maximum flexibility. I mean, they don't answer to lenders. Every bit of profit can go straight back into high-value stuff, like developing their own chips. The sources frame it as strength and resilience, definitely not conservatism.
Got it. Okay, resilience. Before we jump to strategy, just quickly, where's the revenue coming from? The segmentation seems pretty stark.
Very clear, yeah. It's heavily weighted towards one area. Silicon Engineering Solutions. That unit brought in, 11,795 lakhs in Q2. That absolutely dwarfs the Product Engineering Solutions segment, which was around 2,898 lakhs.
So for you, the listener, what's the basic difference there, and why does that weighting matter?
Think of silicon engineering as like the core chip design, the really specialized blueprint work, designing the circuits, verifying them, the physical layout, high-margin stuff. Product engineering is more about taking those chips and building actual systems around them, hardware, software, the whole device. The fact that silicon engineering is so dominant tells you where their deep expertise and, likely, their most valuable contracts are right now. They're chip architects, fundamentally.
Right, masters of the blueprint. Okay, so let's move from the numbers to how they're actually doing it. That 68% profit growth didn't just happen. What's the strategy behind this acceleration?
It seems multi-pronged. They're expanding physical capacity, focusing hard on talent, and making strategic acquisitions to bolt on capabilities. On the capacity and talent front, they're moving into bigger offices, Bangalore and Pune. Now, that's not just about desks. It signals scale. It helps attract top engineers, which is vital in this field.
And the sources mention how they're trying to keep that talent too, right?
Exactly. It's about ownership. We saw they just allotted 137,100 equity shares through their ESOP program, employee stock options. That's standard practice in tech, sure, but it's crucial for aligning everyone with long-term growth. Plus, they're beefing up the board 2 new independent directors just approved for 5-year terms. Mr. Shah and Dr. Rao, experienced hands.
Okay, internal strengthening. But here's where it gets really interesting for me, connecting all this internal stuff to the wider market. They seem to be riding some serious tailwinds.
Oh, absolutely perfectly positioned. They're right in the sweet spot of India's national drive to build up its own semiconductor industry, the government's big initiative.
Yeah.
That provides huge support. And it's not just India. Globally, the outlook's good too. Projections point to something like a 15% compound annual growth rate, CAGR, for the whole semiconductor sector. MosChip is sitting right at that intersection. Global tech boom, national priority.
And we see this mix, don't we? Organic R&D, they're investing in RSEDV, but also buying growth through acquisitions. How important are these acquisitions?
They seem pretty central, actually. It's about quickly adding new skills.
Yeah.
The sources mentioned Softnotics. They bought them back in June 2023. That integration is done now. And Softnotics wasn't just absorbed, it immediately gave them a real foothold in areas like automotive chip design, advanced IoT stuff, things that might have taken years to build organically. They essentially bought expertise.
And they're winning big projects too, which seems to validate this focus on high-value areas, especially those backed by the government.
Definitely. 2 big ones stand out from the sources. May 2024, they landed the HPC Processor SoC Development Project. HPC is high-performance computing, very complex, very strategic. Then in June 2024, they got approval to develop an indigenous smart energy meter IC under something called the DLI scheme.
Okay, let's quickly break that down. DLI scheme.
Yeah.
And why is a smart meter chip important?
Right, so DLI is the Design-Linked Incentive Scheme. It's basically the government's main tool to boost homegrown chip design in India. Big financial support if you design chips locally. Winning that smart energy meter project is significant because it means MosChip is making key parts for a huge national infrastructure project, the smart grid rollout. It really cements them as a partner in that whole Make in India push. They're moving beyond just designing for others to making their own specialized products.
Okay, so let's recap. We've got explosive profit growth, financial resilience being debt-free, aggressive talent moves, strategic acquisitions, major project wins, all fueled by this national semiconductor push.
Wow. So what's the verdict from the market? How does the stock chart look?
Well, the market has definitely picked up on this dual acceleration. The stock price reflects it. It's up nearly 30% over the past year, which is solid. But the real action was more recent. There was a really sharp rally starting around September 2025. The price shot up from about 170 to over 270 in just a few weeks. That shows real excitement building around the Q2 numbers and their strategic position. That kind of vertical move often pulls back hard, though. What are the charts saying now? Is it just pausing for breath, or is it looking shaky up there?
That's the key technical question right now. The stock has pulled back a bit, but it's consolidating. It's basically trading sideways in a fairly tight range. Importantly, it's holding above its 200-day moving average, the 200 DMA. When you see consolidation like this, above the key average, after a big run-up, it often suggests accumulation.
Accumulation, meaning big players are buying in quietly.
Potentially, yes. Large institutions might be using this pause to build bigger positions before maybe another leg higher. And critically, the trading volume stayed high during the rally and during this consolidation. That suggests interest is still strong. It hasn't just evaporated.
Okay, but consolidation can also be distribution, right? Like selling before a drop. Are there any warning signs? Volume drying up on bounces, anything like that?
That's the risk, definitely. If we saw it break below key support levels on high volume, that would be a red flag. But actually, the source material points to the RSI, the Relative Strength Index, a momentum indicator sitting around 54.
Right.
Pretty neutral. This actually confirms the stock has cooled off from being overbought during that sharp September rally. That cooling off is healthy. It suggests the uptrend could continue. It looks more like base building than topping out right now.
So for you, the listener, maybe watching this stock, what are the practical levels? Where's the line in the sand for resistance and support?
Yeah, looking at the chart data provided, immediate resistance looks to be right around 275. Getting convincingly above that would likely signal the consolidation is over and could lead to a retest of those recent highs. On the downside, the key support level seems pretty well defined near 233. That's the level that really needs to hold to keep the current bullish structure intact, especially with the price above the 200 DMA. So yeah, pulling it all together, MosChip looks like it's in a really dynamic growth phase. You've got that stunning 68% H1 profit jump backing it up, plus the physical expansion, the acquisitions clicking into place, the new offices. It all fits. The technical picture still looks bullish after this healthy pause.
Right. So analysts looking at this probably see more potential upside, assuming the company keeps delivering on this fundamental growth. And the strategy seems clear enough. Keep growing design services, that high-margin core. Keep investing heavily in R&D for the hot areas AI, ML, IoT, automotive, RISCV, and push forward with those turnkey ASICs, those specialized chips like the smart meter IC. That was a dense stack indeed. Covered a lot. From chip design specifics to stock chart patterns. Thanks for walking us through MosChip's story here.
My pleasure. It's a fascinating case. And maybe just one final thought for you to chew on, or based on everything we've seen here. Their whole strategy seems to rely on really aggressive expansion acquisitions, pushing into demanding fields like AI, developing their own complex chips. This absolutely requires getting and keeping the very best engineering talent. But the sources themselves flag the cyclical nature of the industry as a challenge, and they specifically mention talent acquisition and retention as needing focus. So the question is, are they building something truly solid here? Or are they maybe growing so fast they risk getting caught out if the industry hits a downturn, or if they can't keep finding and holding on to those crucial engineers? It's that tension, massive opportunity versus the very real risk of execution, especially around talent. That's the thing to watch.
A great point to end on, opportunity versus execution risk. We'll leave it there for this deep dive. Catch you next time.